Maneesh Dangi from Birla Sun Life AMC joins us now to talk about A, asset allocation, B, inflation, and how should one really understand equity as an asset class in this kind of an environment when half the world is worried about inflation, the other half, which is not worried about inflation, is worried about valuations. Bottom line, everybody who's invested in equity market is worried about something or the other. But why is the expression on Maneesh Dangi's face is telling me that he's a very happy man and he's not worried about inflation or rich valuations? Maneesh, fantastic to have you back on ET Now. You've been guiding our viewers with your asset allocation calls, with how one should have participated back into equities in the month of September and October. So thank you for those calls. Equity markets have worked like a charm, and I'm sure our viewers must have benefited because of that. So I'm going to take our conversation forward. Last time when we met, or actually when we met in September, October, you made a serious case to revisit equities. Now, let's look at what is the case why one should not sell equities. Because like I said, half the world is worried about inflation, half the world is worried about valuation. Everybody's worried about something.
So, Nikunj, my template of investing, and of course, everyone has to have a different one, is to buy valuations and sell macro. So in a sense, buy when stocks or markets, and given that I'm a macro, I don't buy stocks directly. I buy markets, and then my suggestion is that, don't sell your positions until the macro has turned bad. Now, you're right that, there are two camps today arguing against equity, and there is this argument of this being a bubble, and I've actually talked about it many times that it's not. The one side of argument is of my kind of people, who actually argue that basically equity markets are always pricked by central bankers, because they start to worry about inflation. They start to cite inflation at some point in time. Would there be an inflation anytime soon? The macro watchers say, look at the money growth of 20%, look at the large fiscal stimulus by developed economies and also emerging market economies. Look at the commodity prices, copper prices are up by 70%. Oil has actually doubled in last 6-7 months. So all of that would actually result in inflation goes the argument. But then, let's do a bit of a reality check here, that over last 10-12 years of QE 1, 2, 3 and infinite QEs, and of course, hasn't resulted in any inflation. The inflation in the developed world has been less than 1%. Of course, in India also during 2014, 17, 18, inflation was pretty tamed. So in a sense, I think from a macro standpoint, until there is some slack in labor markets, meaning until there is unemployment, right now unemployment is still significantly higher than what it was pre-pandemic level. And until that number goes down, the negotiating power of wage earners, people like you and me, would never go up, to the extent that it starts exert pressure on inflation. So my argument against these people from Inflanistan is that actually, it is still 3-4 years away that, labor markets heat up and create inflation. The other argument, of course, Nikunj, is you are well aware of, that when you talk to equity sort of people, more bottom-up investors, they actually argue that look at the P's and price to book ratios. And then they say that, okay, look, from a historical standpoint, they are so expensive. They're absolutely right. But then, all these ratios actually have to be contextualized with respect to where the interest rates are. And today, as a matter of fact, interest rates are at lowest level. US has never had, such low interest rates in real terms today. 10-year US Treasury is minus 1% in real terms, okay? Because markets are pricing at 2% inflation over next 10 years, whereas the US Treasuries are trading at 1%. So that's minus 1%. Now that case is there everywhere in all OECD countries. So essentially, the rates actually in the world, the real rates are super low. And in that context, P's have to stay elevated. So, when people argue of valuation, in the end, the big money or small money has to invest somewhere. And the alternate is a bond. And if bond is going to actually reduce your purchasing power year after year because of negative real rates, you have no option but to invest in positive real rate assets like, what do you call it, equity, which are still likely to deliver a significant equity risk premium. So, I mean, I don't know how convincing is this, but I think the both sides of arguments, the macro and micro arguments, I do not think stand on sort of firm ground to argue that, markets are bubbly. They are, of course, expensive, but, for the reasons that we've mentioned.
Manish, let's take the point forward on the bent of the economy. Now, last time you argued that banks have raised capital, the moratorium numbers don't look all that scary, and they have enough capital to grow, which means the contingency in the system is not bad. But when you speak to banks today, they are not saying that everything is looking hunky-dory. Some of the banks, they continue to provide, and some of the banks continue to maintain that credit growth is not picking up.
No, so banks numbers, I mean, even this quarter, a couple of banks numbers are out, and they're actually in line with this estimates, that Street made after the September quarter results. So there was a lot of positive surprise in September, and I think December would actually confirm that the total losses because of COVID for banks wouldn't be substantial. I think I shared with you last time that the COVID cost for the banking system would turn out to be about 1.5% of the total lending book. So, I mean, we have 150 lakh crore of total credit, and I wouldn't be surprised if the total cost is less than 2 lakh crore. Now, for the kind of black swan which played out, which is COVID, the losses would be relative to whatever has happened in Indian banking many times over every time a crisis hits us. I think it's pretty low. Now, I am beginning to see credit growth pick up, Nikunj, sequentially. Last 3-4 fortnights, you had quite a sharp pickup in credit. And as of right now, if I were to, annualize, it's not a seasonal one, but annualize the last 3.5 months of credit growth, it's already tracking 13-14%. After a long time, actually, credit is showing traction. So, okay, 2 points here. One is that so far, we know that in April, May, June, whatever markets in aggregate thought for the financials that they would end up losing 4-5% of the book because of COVID, it is appearing that it's untrue. It appears that banks will not lose more than 1-2%. Okay. Second, of course, as you said, that banks have been able to, especially the ones who wanted to do credit, the private sector banks and NBFCs have been able to capitalize themselves very well. And then third, you're beginning to see that most banks, you saw Bajaj Finance numbers also, SDFC Bank, of course, is still showing rock solid performance, both in terms of growth as well as NPAs. So my sense is that, they would begin to pick up the thread where they left it before pandemic, and you would begin to see retail growth flaring up over next 3-6 months time. As I said, in last 2-3 months, the annualized growth of credit is already 13-14%. The year-on-year growth of all sorts of credit, when I aggregate, is more like 8% right now. Now, in an economy which has actually slowed and actually contracted, 8% nominal growth in credit is not bad, Nikunj. I'm not too worried. I think we are on track to sort of achieve a significant double-digit growth in credit also over next 1 year.
You've been bullish on real estate, and historically we've seen real estate and equities, they always compete for capital.
Mm-hmm. It doesn't, to a certain extent, it doesn't happen in India. In a sense, real estate is a primary asset for most people. Equity still stays for 1 or 2%ers in this country. So to that extent, I think that competition doesn't exist. But nonetheless, both of them are legitimate asset classes, and actually they give you a good protection to inflation, and which is why, typically they are placed versus bonds. And I've discussed about this, last few times as well with you, that as of right now, real estate looks in a sort of a Goldilocks condition, low interest rates. Today, the mortgage rates are below 7 now, and they're likely to sort of trend even lower, Nikunj. Also, the real estate has seen a 6-7 years of bust, especially in the top 8 markets in India. In real terms and nominal terms, prices have gone nowhere. In fact, they've corrected. So I think, stage is set for a very sharp recovery in real estate. And, as long as, RBI stays sort of put to it and we have no big negative surprises, I think you will see velocity improving dramatically in real estate. You're starting to see, you saw December quarter numbers of Mumbai, but, what we sort of hear from all top 8 cities in India, there has been a significant traction in the residential real estate. Commercial real estate, Nikunj, is a different ballgame altogether. In a sense, it had a big bull market over the last 7-8 years, and then there are slacks there, not just in India but across the world. And so I think that part of the real estate business would take a little bit of a beating and would sort of stay sluggish for a couple of years. But I think the residential real estate, because of the high affordability, low real rates, low rates, and access to mortgage has improved dramatically. I think it's out to fly and would do very, very well over the next couple of years. In fact, Nikunj, my argument on India's growth, that why it would recover for a variety of reasons that I think I've talked about with you many times. I think the household investment is also key to my thesis. And I think that because real estate is in reasonably good shape, you could end up having households beginning to construct their houses rapidly. And that is what drives the investment in India. So, okay, so in a nutshell, I'm fairly constructive on real estate.
Okay, we've looked at the bullish argument why you should not sell equities, why macro and growth parameters are likely to surprise us. But if I have to choose something from your initial comment that the way you invest or the way you advise your clients to invest when you're managing money or your unit holders is you should invest when valuations are bad and you should sell when macros are poor. What will be the indication of a poor macro? Because the first indication of a poor macro is inflation. According to you, if inflation is not coming and growth is coming, so what would be that first harbinger where you would say macro is turning bad?
So basically, the very first is, of course, side of inflation. And the way it works, Nikunj, is that we are in this monetarist world. Majority of asset prices today, where they are today is, it is because of intrinsic value, but it's also a reflection of the kind of job the fiscal and monetary authorities are doing, and pumping so much money out there. The real assets have to actually adjust higher if you have so much money. Now, why would central bankers and fiscal authorities will take a backseat is only when, the binding constraint begin to appear. There is no limit to the kind of debt a government can take and the kind of QEs a Fed and ECBs and RBI can do. The only limit is inflation. And if economy begins to overheat and inflation start to reappear, we'll have no other option but to tame the economy and actually take the demand down so that the inflation can cool off. Now, when will inflation come? Inflation will only come when, at least in the modern economies, it's not about commodity prices, I think I've talked about it that, the commodity prices were skyrocketing during 2003-07. Oil in 5-6 years time then was up from $10 to $100, and yet it did not create inflation. So don't look at commodities and start to think that inflation would return. Then what is that you should look when inflation would return? I think it's about, labor markets getting too hot in a sense that, there are more jobs than the number of people available for those jobs. And that begins a process of you and I beginning to renegotiate our wages. Now, that is what drives at least in modern economies, inflation. Now, when would that come? When a labor participation rate has improved enough and unemployment numbers have fallen enough. Now, how far are we from that point? Very far, most probably. US unemployment still 6.5%. Yesterday's UK's number was 5% up. In India, no one knows the real numbers, but it's very, very high. You still have a lot of labor staying at home right now, don't have jobs. Your barbers and the helps in the world, they're still looking for jobs right now. So there is a lot of slack in labor market, and that has to ease. So Nikunj, if you actually buy the way I drive my investment, for the macro to turn bad, the inflation has to reappear, and for that, the unemployment numbers have to fall dramatically from here. Now, we know after GFC, which is the great financial crisis of 2008, it took really long for the wages to start reappear in most developed countries. In India, it happened during 2011-13 because of the food prices, because we actually lifted MSP dramatically higher suddenly just to align our prices with global prices. But that's not happening right now. Look at how in India also, let's discuss, MSP rises in India over last 2 years on a CPI weighted basis only has been 3.5%. So while some of them will come and tell you that, look, food inflation is what is going to drive India's inflation, most probably they're actually getting it wrong, because we are a food surplus economy. And one of the other reasons why we used to have food inflation is because of the higher MSP rises. But that's not happening now. Supply chain disruptions have eased. So India's food inflation is actually likely to dive down over the next 6-8 months' time. We already see that in last month's number. So to summarize, when would markets be pricked by central bankers, and which is the developed central bankers? RBI's role in pricking the markets actually is limited, because it's a global money which actually prices most assets. So I think it is still 2-3 years away. So it's more of a story of 2023-24. But then, don't get me wrong, I'm not betting on markets have run up a lot. First time we talked about back in April, markets have near doubled since then. So market would actually show their usual characteristics, of 5, 10, 15% drawdowns. But then people who actually argue that it's a bubble, they basically hint as if, 50%, 60% cut in markets is imminent. And that is my argument against them, that no, nothing of that sort is likely to happen, because it's not a bubble. And the macro is still quite sanguine right now for it to actually create enough tailwind over the next couple of years for the markets to actually rally further. And from an asset allocation point of view, I would still advise that people should be overweight equity even today.
Okay, we got about a minute before we wrap. In India, why is that nobody is talking about the rupee? Dollar is weak, forex reserves are high. Somehow we've lost the importance of what currency could be in next couple of months or couple of years.
Currency, Nikunj, is one of the most important it's sort of a pivot for investing in India from outsider standpoint. Now, for an Indian, actually, INR actually to that extent, only for the macro people like me sort of matter. For the local guys, why would they matter unless they're importer exporter? But from a market standpoint, it has this huge role to play. And I think, it's important to understand that as of right now, the kind of BOP, meaning the balance of payment surplus that we've had, and the kind of accretion and reserves that we have had, if you do a counterfactual experiment where RBI had not intervened as much as they did, and let's say they had behaved more like, what Subbarao regime behaved during 2010-11, our currency would have been perhaps 10% expensive. Okay, so in a sense, look, large amount of money is flowing in the country, both in terms of FDI and FII. Okay, now if you are actually getting an excessive sort of money, then you have a choice. You can let the currency appreciate significantly enough that for the outsider, this bet becomes less attractive. But if you actually continue to intervene in currency, which is, by the way, is the right thing to do, because, and I'll explain to you in a while, but if you continue to intervene, then more money would actually come in, So in a sense, the pressure of more money coming in terms of dollar and euro in the country has to be borne either by the currency or by the asset markets. So if currency is kept at firm, then the asset markets will become even more expensive. And which is why my argument, Nikunj, is that in this cycle, unfortunately, many Indians would not be able to even participate in Indian equity because you have rock solid currency, very likely to sort of stay here for very, very long, perhaps 5 years. So therefore, the Indian returns actually become dollar returns for investors, if currency doesn't move. Okay, so that's the broad, case that I would make for equity. From an outsider standpoint, it becomes even more attractive than what it is for an Indian. An Indian would say that, okay, I'm getting a 6%, 10-year government bond, and I'm fine with it because I'm most probably likely to earn 1.5% real return. But then, and your equity perhaps will return 12%. So maybe it's not too attractive for him. But then at 12% dollar return for an FII or a pension fund sitting in Norway or Canada actually becomes sort of so much more attractive because they're comparing with 1% US treasuries. Okay, so to that extent, currency plays a much larger role.
Right, Manish. We're going to leave it there. Fascinating to get into the macros, and I'm just going to archive that line of yours, which is that in equity investing, buy valuations and sell when the macro is bad, and your analysis is indicating that macro is not bad, so one should stay on course if you invested in equities, and don't worry about inflation and valuations because the growth is going to surprise us and inflation is not going to be coming back and haunting us.